Here in this session, I'm going to talk more about the markets, the financial markets here. The money market is a market for short-term funds. You need to understand there is a difference. Capital market, you have two things, that is primary and secondary market. Now, Treasury Bill is all by the Reserve Bank of India. So, call money is a short-term finance, repayable. Please understand. Hello everybody, a warm welcome to one and all. I'm Vidhyaashram from the Department of Business Studies in Vidhyaashram PUC College, the Temple of Excellence. Warm welcome to everybody, and here in this session, I'm going to talk more about the markets, the financial markets here. In the first session, I told you what are the financial markets we really have. I've explained you the points, but now I'll go in depth and you are supposed to know that what exactly is a money market. Now, money market, when I tell you about the word money market, you feel that it's a market where money is actually given, right? So it is not like that, but similar to it, the money market is a market for short-term funds. You need to understand there is a difference. Long-term funds, we have a different market, and for a short-term funds, we have a different market. Now, money market is only for short-term. So it is all about for short-term. So money market is for what? Short-term. Done. So, which deals in monetary assets whose period, you need to understand what is their tenure, what are the year of things. Period of maturity is up to 1 year. So, within 1 year, you are supposed to go with it. That is what the quality of money market is. So, I'll repeat, money market is for short-term funds and it deals with a tenure of how many years? That is only 1 year. These assets are close substitute for money. That means you can convert them whenever you want to. So, these assets, the assets which we go with, you need to know that there are fixed assets and current assets the same way. These assets are close substitutes. So they are very closely, they are substitutes for money. That means money's worth. The major participants in the market. So who are the people who are the major participants? The participants are, now we'll go with it, 1, 2 and 3. The things are like this. One is the commercial bank. We have what? Commercial bank. And then we have non-banking finance, non-banking finance, that is the non-banking financial companies we have. Then we have state government, and still we also have people who are like large corporate houses and mutual funds. So you would have heard about mutual funds, isn't it? It's all deals with what? Money market. So I told you what is money market. Money market is for the short-term funds, and the period is, the maturity is how much? That is 1 year, and it is close substitute of money for money. And then the people who are there, they are the Reserve Bank of India. That is the first one, is Reserve Bank of India. Then we have commercial banks, non-banking finance companies, state government. See, here we have state government, and then large corporate houses and mutual funds. So these are the people who are always there with money market. Next, we need to classify of financial market. So here the financial market, that is, you have the financial market. There are two. One is the money market, another is the capital market. So I told you about the money market. Let's go with capital market. Here, capital market, you have two things, that is primary and secondary market. So here what happens is, when it comes to the primary and the secondary, you need to understand that we have two things. One is debt, and one more is equity. That means the debenture, and then we have the equity. So these are the two things. Debenture, in the sense, the people who will give the loans, and the equity are the people who actually are the owner of the company. So you have, one is the debenture and one more is the equity. So let me just tell you, financial market. Here in financial market, there are two markets. One is money market, another is capital market. Now in the capital market, we have two types of market. One is the primary market and one more is secondary market. So here when we talk more about secondary market, it's all about the stock exchange. And when it comes to the primary market, it is the market where the company will give the fresh shares to the public. So you need to know about IPO, you need to know about so many kind of initial public offering is called as IPO. And here they deal with what? One is debenture, another is equity. So here again secondary market also you have what? Debenture, and then you have equity. So let's check money market instruments. So which are the money market instruments? I've given you a few of the money market instruments. The first one here is Treasury Bill, and then you have commercial paper, call money, certificate of deposit, and then commercial bills. So here see, don't get confused with commercial bill and commercial paper. So both are not the same. It is totally different. Here you have commercial paper and commercial bill. There is a difference. I'll tell you what exactly the difference are. Now treasury bills, what exactly those things are? The period is how much? It is for 1 year. The maturity is for how much? 1 year. So I'll tell you what exactly all these things are. Now the first one is treasury bill. What is this treasury bill? Now treasury bill is a basically an instrument of short-term borrowings. It's a short-term borrowings. I told you, right? Now money market, you have something like the RBI will be there, which they'll get involved. Mutual funds are there. State government is involved. Non-financial companies are involved. So here what happens is they need some kind of a bill. And treasury bill is what? It's a short term. The treasury bill is a basically an instrument of short-term borrowing. So whenever I need to go for borrowing, I need to go with this treasury bill by the government. Who will actually give it? By the government of India, maturing in less than 1 year. So the tenure is how much? 1 year, less than 1 year. They are also known as zero coupon. They are also known as zero coupon. And that too what? Zero coupon bonds. See, whenever the government is issuing something, we usually use the word called bonds issued by the Reserve Bank of India. So who are all there in the money market? Reserve Bank of India, I told you, no. Now treasury bill is all by the Reserve Bank of India. And India, on behalf of the central government, to meet its short-term requirement of funds. So whenever the central government needs something, so they'll go and they'll ask the Reserve Bank of India that we need a short-term borrowings. So you are supposed to give. So the Reserve Bank of India will actually give a loan to the government, and that is how the treasury bill is used. So what exactly a treasury bill is? A treasury bill is basically an instrument. When I say instrument, that means that is particular material for that every process will happen through that material, through that instrument, every process will happen. So the Reserve Bank of India will give the central government the borrowings, that is the loans they'll give, and that loan actually the instrument which they use is treasury bill, and that too the tenure will be less than 1 year. Less than 1 year they are supposed to give it back to the RBI with interest. So here commercial paper, it's again one more money market instrument. Again, it's an instrument, but here what happens is it is unsecured. There is a difference, secured and unsecured. Commercial papers are all unsecured. Commercial paper are what? Unsecured promissory note. They're what? Unsecured promissory note. Negotiable and transferable. When I say negotiable, means you can actually deal with it, you can work on it, you can actually minimize it, you increase it, you can negotiate with it. As well as it is what? Transferable by endorsement and delivery with a fixed maturity period. With a fixed maturity period. Next one, it is issued by large and credit worthy. It is issued by large and credit worthy companies to raise short-term funds. So who will actually go with it? That is the companies will go with it at a lower rate of interest than market rate. So here if you go with commercial paper, what happens is the way the market rates are, the interests are by the banks. What here happens is if you go with commercial papers, then what usually happens is the interest rate will come down, and it is actually a benefit for you. So that is why they use commercial paper. Next we have is call money. Now call money is not like I'll just call and then somebody will actually give me the money. So it's not like call money. Call money is a short-term finance. Again, see, every money market instrument is what? Short-term finance. Money market deals only with short-term. So call money is a short-term finance, repayable. Please understand, commercial paper is unsecured but negotiable as well as transferable. Here what it is, call money is a short-term finance, but what it is, the quality is what? Repayable on demand. Whenever you demand it, it is repayable with a maturity period of 1 day to 15 days. So here the maturity is how much? 1 day to 15 days. So call money 1 to 15 days. That is less than 1 year, isn't it? Used for interbank transaction. Interbank transaction, whenever a bank will go with a transaction with another bank, so here they'll go with call money. Commercial banks have to maintain a minimum cash balance known as cash reserve ratio. I'll talk more about this cash reserve ratio in the next sessions, but here you need to understand, now whenever you deposit something, whenever you go with it, interbank, whenever they deal with it, they deal with one instrument, and that instrument is called call money. Next is certificate of deposit. Certificate of deposit. So here what happens is, certificate, what exactly a certificate is all about? Have you deposited or not? So you need some proof, right? That is what the certificate of deposit. Now what is that? I'll just tell you. It is denoted as CD. What is it? It is always called as CD, certificate of deposit. Now again, certificate of deposit is also unsecured. They are what? They are unsecured. Unsecured. When I say unsecured, it is also negotiable. It is also what? Negotiable. Negotiable. Okay, and it is what? It is a short-term finance only for the borrowing kind of bearer issues. Who issues that? That is the bearer firm, and issued by commercial banks and developed financial institutions. Who will actually issue it? The commercial banks and developed financial institutions. Only those people can actually issue certificate of deposit. They can be issued to individuals who can actually take it. The individual, whoever are going with a business or any kind of a thing, they can actually take it. Individuals, corporations and companies during period of tight liquidity. When they don't have a kind of a cash, then they can go for this. When the deposit growth of bank is slow, but the demand for credit is high. See, sometimes what happens, due to demand and supply, due to some kind of a thing, the bank also doesn't have enough fund, right, to issue. So what they usually go with it is, they can be issued to whom? Individual, corporation and companies during what? During period of liquidity, when the deposit growth, see, when the deposit growth of the bank is slow. Deposit, that means people are actually investing less, in the sense it is slow, but the borrowing rate is more. The borrowing rate is more, the credit rate is more. That is the time you go with certificate of deposit. So please understand, it is a unsecured and negotiable short-term finance. And here what happens is, it is issued by whom? The commercial bank and developed financial institutions. Next one is called commercial bill. Now commercial paper is totally different and commercial bills are different. Commercial bill is a bill of exchange. What is it? Commercial bill is a bill of exchange used to finance the working capital. What is it? Working capital. Now you need to know what exactly a working capital is. Day-to-day activity, whatever happens, we require a capital, that is called working capital. Requirement of business firm. So commercial bill are used for bill of exchange, that is only used for to get the finance for the working capital. It is a short term negotiable self-liquidating instrument. It is what? Self-liquidating instrument. If you just have commercial bill, it is only what? Commercial liquidating instrument, which is used to finance and credit sales of firm. Sales of firm, it is used when goods are sold for credit. So whenever the goods are sold on credit, the buyer becomes liable to make a payment on a specific date in future, and commercial bills are used. So this is what the thing what commercial bill does. So it is what? It is basically the bill of exchange. It is what? Bill of exchange. And when it is used, you need to understand when goods are sold on credit. Now I have sold the credit, I have sold the goods on credit. The buyer becomes the liable. That means he becomes the liable, right? So I have sold the goods. Now I have taken a credit. Now what happens is the buyer need to pay me. So here he makes a payment on specific date in future. So I'll have that commercial bill. This is what commercial bill does. So these are the things which we need to understand in the money market. Now money market is for the short term and the period and the tenure is only for 1 year. So you have gone through these money market instruments. So I have told you what are commercial paper, commercial bill, certificate of deposit and treasury bill. So these are the things which you are supposed to know. If you have any confusion, any doubts, you can just call us. We're always there to help you. Thank you so much. I'll see you when I see you.